Hi, everyone. Welcome to this week's market update. I'm here with Eric Anderson. Eric, it's been another volatile week. What stood out the most to you?
This week, the bond market reasserted itself as the headline act, and not in a good way. A 20-year Treasury auction went poorly, clearing at a yield above 5%. That's not just a technical hiccup, it's a signpost. Investors are stepping back and asking, who's going to absorb all this debt? The narrative is shifting. Just weeks ago, it was all about tariffs. How high, how broad, how disruptive. But now the question is more fundamental. Can the US actually fund its fiscal promises without breaking the market? And it's not just a US issue. Japan is having its own bond market reckoning. Yields on long-dated JGBs are at levels not seen in decades. And for the first time in a long time, Japanese bonds, backed by an appreciating yen, are starting to look like a real alternative to treasuries.
Let's zoom in on the U.S. fiscal situation. What's driving the concern?
In short, a mountain of debt and a Congress that just keeps climbing. The House narrowly passed the latest spending bill by a single vote, and if it clears the Senate, we're looking at another $3.3 trillion added to the federal deficit over the next decade. That's on top of already elevated interest costs. Let's not forget, net interest payments are now the second largest federal outlay, just behind Social Security. And with the average coupon on existing debt well below current yields, refinancing is only going to get more expensive. This is the crux of the problem. It's not just that rates are higher, it's that they're colliding head-on with structural deficits. That's what Moody's downgrade was really about. It wasn't a shot across the bow, it was the opening salvo in what could be a long revaluation of U.S. fiscal risk.
Equities haven't completely unraveled, though. What's supporting them?
There's a tug of war going on. On one hand, we've got signs of resilience. Industrial confidence came in slightly ahead of expectations, and the recent moderation in tariff expectations is giving markets a bit of breathing room. The working assumption is that Trump's 27% Liberation Day tariff spike might settle closer to 13%, still high, but far less catastrophic. On the other hand, housing data remains bleak. Existing home sales are near their weakest levels since the global financial crisis, and prices remain prohibitively high. That's a key canary in the coal mine for consumer strength, and right now, the bird isn't singing. So markets are holding up, for now, but under the surface, there are real signs of stress.
Let's talk inflation, especially the UK. Is this the beginning of another global surge?
The UK caught everyone off guard. April CPI jumped to 3.5% from 2.6% the month before, well above the Bank of England's 2% target and its own expectations. The culprits? Soaring utility bills, a spike in services inflation, and cost pressures from higher wages and taxes. This complicates everything. Markets had been pricing in another 75 basis points of cuts from the BOE this year. That now looks optimistic at best, delusional at worst. The credibility of the MPC is taking a hit, and a rate-cutting cycle may be on hold for far longer than expected. What's unnerving is that while this may be idiosyncratic, it comes at a time when bond markets globally are twitchy. Japan's inflation data is due soon, and if it surprises to the upside, you can expect further pressure on global yields.
The crypto crowd is back to watching gold. What's happening there?
Ah yes, Bitcoin and gold. They've relinked. After diverging for much of Q1, they're back in tandem. Since March, both assets have risen on renewed fears around fiat credibility, rising deficits, and geopolitical noise. That correlation is often misunderstood. It's not always about inflation, it's about distrust in the system. And right now, that theme is resonating. The fact that both Bitcoin and gold are rallying in sync tells you that investors are looking for hedges against policy error, against sovereign risk, and against a weaker dollar.
That's it for this week. Stay tuned for more insights next time.